This video is called "The Next 90 Days Will Make Millionaires in 2025."
One of the best analysts in the business just said that this current market downturn is going to make a lot of millionaires. Let's find out what he's talking about. Now, he made a lot of splashes over the past few years, starting all the way from 2023 when everybody was bearish. He was bullish. Of course, he got the right call, but now he's coming out again against the grain. In his latest media appearance on the Risk Reversal Media podcast, full video is linked below, he talked about tariffs, recession fears, but he also said, buy the dip. I'm going to play you a highlight reel of about 4 minutes from that interview. Then I'll share with you my analysis, my recap of everything he said and my reactions. And then we're going to do an interesting exercise. We're going to put his words to the test. We're going to use objective data and statistics, historical data to test whether it is actually the smart thing to buy the dip during a downturn. Because maybe the smarter, more effective strategy is just to hold. We'll see. We'll find out with data, not emotions, not hunch feelings, none of this
Oh, this sounds great. I like where Tom's going with this.
gut feeling stuff, just actual hardcore data. But as always, first of all, don't click nothing, don't smash nothing, don't buy nothing, just listen. Let's play the highlight reel.
So the investors view this as a crisis when it's really a growth scare. So to me, I think there's a good chance we're making our lows for the first half, like this week. And
like down 5-6%, you mean?
yeah, it could be.
Yeah.
I mean, the only thing is I'm not that optimistic about the job picture for the near term. So maybe that's one last leg. But the reality is that a lot of bad news has gotten priced in. If someone is playing AI today, it's not a mistake to bet on the leading companies for now. And so that means...
No, not at all. In fact, betting on the leading companies is how the market is played, right? If you have a sector that's doing really well, and then you buy the best stock in that sector. We just talked about this before we started the video. 40% of the stock's move is due to the market. 30% of the stock's move is due to the sector, and 30% of the stock itself. If you can align the market and then the sector and then buy the best stock in the sector, it's like a slingshot, right? You're pulling everything you can and pushing it all out in the same direction. Whereas if you're buying the worst stock, even in the worst stock in the best sector, it's still going to underperform. So Tom Lee, 1,000% right on this.
NVIDIA and, other tech names around that. So I think the market is getting all that right. And they're getting the power right and the need for things to support the expansion of data centers. But what they have to be mindful of is the correlation of all that is 1.0. Like they're all going to stop working at the same time. Once the tariff talks go away, the environment is favorable for American-focused companies, which would be, small companies, and they'll benefit from lower rates and their multiples are...
And not to get political, but that's Trump's whole goal, is to make this a American-centered economy instead of a global economy that has to come to America, make it an American-centered economy. So American companies should benefit. So I'm agreeing with this too.
Are lower. So I think it's still a big opportunity. But in the middle of tariff talks, none of these groups can really do that well. Well, inflation is a problem because prices aren't going to go back down. And they're up 50% over the last couple of years. And so I think it's going to be harder and harder for consumers to tolerate more inflation. Like even if it's still at 3%, it's still going to be unbearable. If I look at it from a markets lens, I know a lot of people are saying that there's a second wave of inflation underway, or it's picking up and you're seeing it in the consumer surveys. I think one, we don't know what the seasonality is. And I think the consumer surveys themselves are actually very flawed right now. And they're picking up less the fact that egg prices are up. And I think more political respondents, like the UMich survey, there's a huge bifurcation between Democratic views on inflation versus Republican. And the bond market itself is giving very conflicting messages about inflation. In fact, I would say if I looked at what the bond market's saying, I think it's saying there's no problem with inflation. The reality is that if policies are enacted that create such a severe shock because of tariffs, then we could have a recession, right? I mean, that's like a fact. Because if you put a 300% tariff or something, we don't really know how to titrate that number. And that's why investors are nervous. But it's at the same time, the tariffs are accomplishing the administration's goals. Because if I was the White House and I know that I have some opposing risk from the Fed today, because the Fed's hawkishly paused. Well, if the tariffs are causing confidence to fall and business activity slow, then the Fed has to get off neutral. But then everyone's playing a dangerous game because, as you know, you don't want to get stall speed in the economy, because the day the economy gets to stall speed, we open up the uncertainty of a recession, because a shallow recession, a recession is unknown once it starts.
So as you just saw, Tom Lee was talking about a lot of stuff. He was talking about the fact that the stock market is currently having a bad hiss of it. We all are feeling it. But he basically says, look, being bullish like myself in a negative sentiment environment is hard, right? I totally understand this. And I've also talked about this in my latest Zoom meeting with my members. And I said, look, the most important element of long-term investing is the mental game, right? The mental game of investing is where millionaires are made. Warren Buffett actually said this in one of his most famous quotes.
Dude, I couldn't agree more. Like the hardest part of being an investor is the mental game. right? And that's why I really enjoy going to all those trading psychology videos that we cover, because for me, I think that that's so important to talk about. And in fact, I find that the most fascinating part of trading and investing is actually the psychology aspect of it, because you, as an investor, when you see prices going down, you might be thinking, oh man, now's a great time to buy, right? The stock is on sale. Like, how many times have you gone to the suit store, right? How many times do you try to put on your best John Wick look with the all black, and you go to the suit store and you're like, listen, Men's Warehouse, I need, because I don't shop at Brooks Brothers, I don't shop at Armani, I need a new suit that is all black, and when I buy the suit that's all black, it needs to be on sale. You're like, oh, okay, here's your suit. Whereas if you were going to Brooks Brothers and Brooks Brothers is raising prices, the fact of you wanting to buy that stock as the price is going up, like if you were to buy the suit as the price is going up, it makes it a lot harder. Makes it a lot harder. So when people see a stock that's going down, like AMD, they look at it and they're like, wow, this is a great opportunity to buy something that's on sale as it's going down, as it's going down, as it's going down. But as a successful trader, as a successful investor, you want to have the wind at your back. You want to have all these people screaming at the top of their lungs, buy, 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 because you aren't the one person who's going to make the price go up. You need all these people to help you make the price go up. So you have to make sure that everybody's buying it at the same time you're trying to buy it, which is almost counter to what most people would do in most circumstances. And we've heard it from Tom, we've heard it from Jeremy, we've heard it from all these different investing channels, right? When they see a stock like this, they get excited. When I see a stock like this, I get very nervous. Like, whoa, I don't know where this is going, but it certainly is not going there with me.
Is when everybody's bearish and bullish, it's not as easy as it sounds. It's very, very hard to be bullish when everybody all of a sudden become bearish. And that's what Tom Lee's talking about. He's 100% correct. If this was easy, everybody would be a millionaire. It takes a lot of courage, a lot of guts to trust your thesis, even though everybody around you are panicking. Now, he also...
But to that point, to disagree with Tom here, I think it takes more courage to buy the stock on its way up, in my opinion. And this actually goes to what Mark Minervini said. If you can go watch that video that I did just the other day with talking with Mark Minervini there, it's harder for most people to buy a stock as it's going up because they feel like they bought it at the wrong time. They've been told to buy low and sell high. And when they see it going up, they're like, oh, I missed the boat. Oh, I missed the boat. Whereas over here, they're like, oh, I have to buy it now as it's going down. And it can go down from 400 to 350 to 300. He lost $100 a share so far. Not a great value. Whereas if it's going up at 300 and you see it go up to 325, you're like, whoa, this is pretty cool. Let me get on board with that. And then it's going up. Right. At the end of the day, if something's going down, you're not making money because only price pays. Oh, I got to do it today. I was so excited to do this.
Dropped, I think, a golden nugget here. And he actually said, look, folks, geopolitics, wars, nothing to get excited about. Right now, we have a war in Ukraine. We have a war in the Middle East, right? But none of these wars that's been going on for a year, 2 years, none of them have slowed down the U.S. market. Why? Well, that is because the U.S. stock market has been historically unaffected by geopolitical tensions. And looking on geopolitics as a way to infer about what's going to happen with the U.S. stock market is just not a good way to utilize data. And I think he's right. Over the past 15 years, we had a lot of turmoil across the world, not just wars, a lot of geopolitical mess. And yet, over the past 15 years that we've saw this turmoil, well, the S&P 500 gave you 700%, not too shabby. And of course, he talked about the elephant in the room, the Donald Trump tariffs. Now, to his credit, he didn't dodge the question and he didn't play it off. He said, look, the tariff risk is real. And I agree with him here, right? He says basically that this risk is not something to disregard or...
Logan, thank you for this. Thank you for that comment. He is a long-term trader. So buying stocks going down in a downtrend doesn't usually pay off. Buying stocks in a downtrend can leave you something like, I honestly don't know, HPQ. I honestly don't know what this looks like here. I'm just picking one at random, right? If you buy stocks in a downtrend, here we go. You could be looking at months, like in 2022 when it sold off, months before it comes back this high, right? So June of 2022, it fell from around $40 a share down to $24 a share. I just picked this one at random, $24-ish a share. and then it came up a little bit, and then it came back down to $25 a share. And then it came up a little bit, back down to $27 a share. And then it came back up. And then the very first time it came up to this area was 2.5 years later. 2.5 years later. My dude, and this is not a criticism to you, Logan, but my dude, in that 2.5 years, you could have like done a lot of great trades instead of holding just the one, hoping and praying that it comes back. Hoping and praying that comes back. I always go to AMD because this is like the best, most recent example, right? It's been going down since October of 2024. We're now in March of 2025. When is it going to stop? When is it going to stop? We don't know that. We don't know that. So buying a stock in a downtrend, in my opinion, is just setting yourself up for failure. You're adding additional stress and risk that you don't have to. If you really wanted to buy AMD at 100, you can still buy it at AMD at 100 when it's going back up the other direction. You can still buy AMD at 100 when it's on its way up, rather than buying AMD at 100 when it's on its way down. But really appreciate you, Logan. I don't want you to feel like that was a criticism. I just want to talk about how important it is to follow the trend, because the trend is, at the end of the day, the only thing that matters. If the trend is going up, you're not going to make money until it starts turning around. And Captain Palatao says, only price pays, and I'm sitting on 100% cash, and I am too.
Ignore. If Donald Trump decides to pull the trigger and go ahead with this, well, all hell actually may break loose. I agree with him here. Let me explain what he's meaning here. And he basically, in my opinion, says this. He said, look, if Donald Trump is real with this, if he's going to go through with the tariffs and he's going to ramp it up and ramp it up and ramp it up, eventually what's going to happen is that the cost of living in the United States is going to go up. Inflation is going to go up. And then if inflation is going to go up without the wages going up, then we might see a situation of a stagflationary environment, high unemployment and high inflation. And that is a recession, and that is a stock market crash. Nothing is ridiculous about that statement. I think he's 100% on point. The guy who holds the keys to this is Donald Trump. How far does he want to take this tariff thing, right? How far does he want to take it? Only Donald Trump knows. He's the most unpredictable person on earth. If Trump actually decides to pull the trigger on this and we're seeing a more recessionary environment because of higher inflation, well, the Fed wouldn't be able to help. Because if inflation is elevated and we have a recession, cutting rates and bailing out the market isn't an option anymore, because cutting rates is going to send inflation even higher. So the Fed is going to be locked out from helping the market in this particular scenario. So Tommy is actually right, a lot of risk. But he also says, look, despite this current volatility, he doesn't believe that Donald Trump is going to crash the market. And to his credit, most of the market shares that sentiment.
I can't imagine that Donald Trump would, especially Donald Trump himself. Now, politics aside, if we evaluate Donald Trump as a person, he very much wants to be the guy who is known for winning, right? Of course, like that's his whole brand. And if the stock market's going down, he feels like he's not winning. So I can't imagine that he's going to let the stock market go. I really can't imagine. In fact, best story I can ever give you about how to control your risk was the night of election night between him and Hillary, 2016, November of 2016. I remember I was completely loaded into my account, 100% portfolio in a specific trade called a call ratio back spread. Now, I used to be very into like exotic option trades. I'm not into it anymore. I just do like basic long calls, basic long puts deep in the money. So a call ratio back spread looks like this. Open image in new tab. And the night of elections, let's say that the S&P was at $50, okay? This is a really, really good opportunity to explain just how important it is to control your risk. Imagine the night of the election, the S&P is at $50. And so all of my trades were on S&P, IWM, and DIA and QQQ. I was like, I'm just loaded in, because how could I lose? This was my thought. How could I lose? Because if the market goes up, because Hillary at the time was supposed to win, right? That was the consensus. Hillary was supposed to win. And if the market goes up, if she won, the consensus was that the market would go up. And Donald Trump was not the favorite at all. And the consensus was that if Donald Trump were to win, the market would go down. So logically, you're looking at this just like I am. And I'm like, wait a minute. She's expected to win. And I can make more money as the market goes up. This is the greatest trade of all time. And even if she doesn't win, I can still profit if it goes down and Donald Trump wins. So the night of the election, I remember it was lock limit down. I have never seen in my entire trading career lock limit down ever. And it was lock limit down that night. which means that it could not go any further down when Donald Trump was winning. And so I went to bed. I was happy. I was like, oh, that's fine, no big deal. Trump's going to win, and I'm going to have more money in my account than I did yesterday because it was in this area over here. And let's say on this side I might have made 1,000, and let's say on this side I might have made 10,000. Right? We'll just use whole numbers here. So I went to bed kind of happy, like, this sounds good. I woke up the next day and the market went up, and went up for basically the next 4 years. But here's where I went wrong. And this is why when I talk about options trading, like you have to not only nail the direction, but nail the time frame. And I horribly broke the time frame here. And this caused me to blow out my account for the second time. And the time frame here was, the election was on Tuesday night. Okay, so imagine Tuesday happens, and we're right here. The next day is Wednesday, and we're right here. The next day is Thursday, and we're right here. And the next day is Friday, and we're right here. Okay. The problem was that my options expired this Friday, right there. Now, if I had let them go for a month out, I'd have been fine. But my options that I put on Tuesday expired that Friday. And so my account was evaporating minute by minute. As the market was going up, my account was going down, and I was trying so hard to figure out what I was doing wrong. I had the right trade. I just had the absolute wrong time frame, and I didn't respect risk, and I ended up blowing my account on this one, and it was awful. So that's my little tangent of the day about how important it is to understand A, what you're trading, and B, know your risk. I had no idea how to control my risk on this trade, and it cost me dearly.
If the market thought Trump is going to take this all the way through and actually cause this, the pricing of the stocks we're seeing right now would be a hell of a lot worse. Things would be much worse if people actually believe Trump is going to go through with this. Now, he thinks that this current situation we're experiencing over the past 5 days is a growth scare, not a crash. Who knows, right? He says, look, near term, we're going to hit lower lows probably, but long term, a lot of upside in 2025. It's very hard to predict these things. It's all depending on the Donald Trump effect. If Trump decides to crash the markets, nothing we can do, nothing we can predict. I would say that he's right if Donald Trump doesn't push the button. But if Trump decides to go through with this analysis is pretty much worthless, right? Now, he also talked about the fact that he believes this is going to be about a 5% correction, not really a 10% correction. What is he talking about here? Well, as you've been listening to me over the past few years.
Here, let's just take a look at the market real quick. It just opened a minute ago. Thank you, Nico, for that. Ding, ding, ding. So we still are in a bearish trend right now. If we close above the 50, I will not put on any short trades. But I don't know where it's going to close today. Of course, it just opened. A 5% correction. We saw about 4.5% from the high to the low right here. And like even that was enough to scare people. I think if we see a 10% correction, I think it's going to be, I think people will be absolutely terrified on a 10% pullback. Like they're just not used to it. Their risk has been negligible. There's been no risk control in the last couple of years because people just think the market always goes up, right? They've dollar cost averaged into something that always goes up. And there will be a time, just like in 2022 or in 2020, where it takes months for the market to come back. Months, right? From the peak on literally the last trading day of 2021 until January 23rd of 2024. That's how long it took to take that back to break even right there. And there's no guarantee that that does happen. We looked at the Qs the other day. When the dot-com bubble burst, it took like 16 years to come back. Are we looking at something like this? No, but it definitely gives me a little hesitation here long term.
I've been beating the drum of, the S&P 500 corrects 3 times per year, 5%, and once in every 3 years by 10%, right? So what Tommy is saying, this is probably not that 10% in a 3 year, it's probably the usual quarterly 5% pullback, nothing to get excited about. Do I agree with him? We'll find out. He thinks that this is a temporary glitch. We'll see if this is a bug in the windshield of the market or it actually is a huge stone that's going to, derail the car. So far, year to date, the S&P 500 is actually up 1.5%, and the past week we dropped 1.2%. So we're far away from that 5%. There's more to go. And if you wanted a good answer to why I'm not 100% in Palantir and Tesla, a lot of people have asked me the past 2 years when Palantir and Tesla were flying through the roof, and people were telling me, well, Tom, why do you have 40% of your portfolio in the lagging S&P 500? You could have been in Palantir and Tesla 100% because look at this potential. And I've always told them, be careful of the floor. They have a...
If somebody's telling you to put your whole portfolio in one trade, like I just described a minute ago, they don't understand risk. They just do not understand risk. Even if it's the S&P 500, you don't understand risk.
Way lower floor than the S&P 500. And the last week we just had in the stock market is proof. Having a 1.2% drop off in my 40% section of the S&P 500 feels a lot better than that 32 and 20% drop I have in Tesla and Palantir. Let me tell you about that. Now, look, obviously this isn't permanent, but I like to have some insurance, and the S&P 500 is this nice warm blanket I can cover myself with in weeks like this, man. This is a huge proof of my concept. Now, short-term turbulence, according to Tom Lee, is definitely to be expected, but he still believes that 2025 is going to be a great year. Now, I want to talk to you a little bit about the theory that I have in my head about why these market downturns are really important for investors, and it has nothing to do with Tom Lee, right? Think about a lobster. Did you ever think about how a lobster grows? I mean, I didn't know up until a few weeks ago how lobster grow, but apparently they're these mushy creatures that grow in this really hard shell, and that shell doesn't expand. And when they grow to a certain point, the shell becomes uncomfortable, unbearable, and then they shed that shell and they grow a new one, et cetera, et cetera. And they do it again and again. Every time they grow, they become uncomfortable, and so forth and so forth. Now, think about how it applies to investing. If you've lived through a lot of crashes, you're absolutely immune to this panic and fear. Even if you went through 2022, if you just started investing in 2021, you've seen the hype, you crashed in 2022, even then you're forged. You've seen it, you wrote out that discomfort made you stronger. Now, a lot of new investors, they don't have that. They haven't lived through 2022. They don't have that to rely on and something to build on as far as creating this wall against the panic. And that's why I'm making these videos to tell them, hey, I've been through this, not my first rodeo. This happens. It's absolutely normal. Now, the way we grow from here is by understanding that we have two scenarios. Scenario number one, that Mr. Tom Lee is right about this. In that case, nothing changes. We keep going, chugging along, dollar cost averaging into our favorite stocks and the S&P 500. But what if Tom Lee is wrong? What if we're actually headed for a crash? Well, what do you do in this situation? Do you keep buying even though you understand you're heading even lower down?
Okay, I really want to hear Tom's opinion here because like only price is going to pay. There is no world, if you're dollar cost averaging the mess out of this, right? If you're buying the mess out of this and yet price goes down, you will own buttloads of shares and you're losing money on every single one of them. And that's okay if you want to hold it, but I certainly will not be holding it with you.
Do you slow down? Do you sell? What's the best strategy in a downturn, in a crash? And is it actually smart to keep buying when you know that the stock market is going to go lower? Well, in my previous video, I told you something very important. I told you that bear markets create millionaires. And I showed you that over the past 100 years, we had 20 crashes in the stock market. That's about every 5 years, we have a crash. And over the past 25 years, the last quarter century, we had 4 crashes, 2000, 2008, 2020, mini crash in 2022, the bear market, right? And even though we had 4 crashes in 25 years, if you just set the S&P 500, you did 500% of your money. You 6x your money. Now, why is that the case? Well, that is because, as I explained in my previous videos, bear markets tend to last a lot shorter than bull markets. Bear markets about 10 months on average. Bull markets are 5 years on average. So you see the difference. You have to play the odds. If you understand that the bull market is 5x more likely than the bear market, well, you know where to put the money, right? It's pretty obvious. Now, look at the COVID crash. In the COVID crash, we went down to 2,300 in 2020. Not that long ago. Just 5 years ago, we were 2,300 on the S&P 500. We're now at 6,000. We've made 200% in 5 years. And if you just set out because the COVID crash freaked you out, you just missed on one of the greatest rallies. Now, all of this is fine, nice, and dandy, but Tom, you promised us data. Where's the data you promised us, Tom? Show us the data that proves that this is indeed the right strategy. Buying the dip is the right strategy. Well, hang on, that's important. I'm about to. So I want to show you this article from Market Sentiment on Substack. This is not a sponsored video. I'm not affiliated. I'm not making any money from them. I just think they got a great newsletter. And they wrote a piece called Buy the Dip. In that piece, they actually showed 3 possible scenarios. They took
Man, if I had more energy today, I would be just like ripping this to shreds. Sure. Buy every dip you want. Buy every dip you want once the dip has stopped. Now I'm going to ask you in the chat because I know you know. How do you know when the dip stops? Buy every dip you want when the dip stops. And how do you know? 5, 4, 3, 2, 1. Use the outlier trend template. And it's so easy. You put 3 moving averages on your chart. Night was the first one there. When your 10 is over the 20, price is over the 50, mathematically, the dip is over, right? Now, there are times where it might come back the other direction, right? It might do something like this, and you might make a buck, you might lose a buck, but then you know mathematically, because it's your shorter term, your intermediate term, and your longer term, all pointing in one direction. When all of those are pointing in one direction, it's telling you right there on the chart, okay, you know what? The dip is done. Because if you're buying the dip, every time that this happens, you could be looking at this situation. like AMD, where your money just evaporates day after day after day. And every little bounce, like this 1.5% bounce this morning, you're like, oh, yes, here we go, straight to the moon. But yet you're down 50% on your investment. And if you're down 50% of your investment, let's go from here to here. Is that 50%? No, it's 30%. If you're down 50% on your investment, you actually have to double, right? You have to double. If your stock goes from 100 to 50, it now has to double to go from 50 back to 100. So hang tight, relax, and do the 10, 20, 50 boogie. Do the 10, 20, 50 boogie, right? Do the outlier trend template. It'll tell you. It'll tell you. So real quick, let me introduce myself. I forgot to do that. I know I'm just who the hell is this random guy on the internet? Well, my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009. I've blown up my account a couple times in the process too. And this is where outliers like us save time, make money, and start winning with less risk together as a team. Now go ahead and subscribe if you haven't already, and we'll be ranking this video in just a little bit. So let's see what he has to say about buying the dip. And again, I have no problem with buying the dip once the dip is done. And you know when the dip is done because you know the outlier trend template.
Took 3 hypothetical investors, Cautious Charlie, Average Andy, and Daring Dave. They started investing in 1998 with $0, and they invest $100 every month into the stock market like clockwork. And they invest all the way to 2022, right? For 24 years nonstop. The only difference is that Average Andy, what he does, he basically just DCAs, dollar cost averages across those 24 years. He doesn't even check his account. He doesn't care. The Daring Dave guy, which is a lot closer to my theory, he basically does the same thing, but when the stock market drops 10% below the all-time high, which is called the threshold point in this article, well, in that case, he goes and buys $200 instead of $100 because he's doubling down on the dips, right? And then
I'm going to tell you right now, this data is already going to be skewed where it's going to be like, oh, buying the dip is so smart. And I'm going to tell you why. Because first, we know the S&P 500 looks like a 45-degree angle, right? We know that. We know it does. So putting it on something that looks like this, you know what the outcome is going to be at the end of the day. Like, we don't need to know anything else. Second, this guy doubles his usual. If you double your usual investment when the stock is down, you are not only asking for trouble, but you went and knocked on Trouble's front door and you're like, excuse me, is Trouble home? And Trouble Trouble kicks the door down with a 12 gauge and it's like, you looking for me? Because you just found me. Oh my gosh. But anyway, let's see what he has to say.
Then we have Cautious Charlie. Cautious Charlie also does DCA because he's smart. He understands that dollar cost averaging is the right way to invest. But anytime the stock market dips 10% below the all-time high, he stops the dollar cost averaging until the market recovers, right? And they've tested this theory over the past 24 years, from 1998 to 2022. Who outperforms who? And the results are going to shock you. So while Cautious Charlie returned 239%, not bad. Well, Average Andy returned 334%.
Nobody should be surprised at this because the data, we know what the data is going to show. We know what the data is going to show. Do the same thing on AMD. Do the same thing on something where it doesn't go up at a vertical 45-degree or a 45-degree angle and see what those outcomes are. I would be very curious.
A lot better. But guess what? Daring Dave, the guy who was doubling down, returned 376%. So data shows if you take a 24-year chunk, the guy who has been doubling down and dollar cost averaging outperformed.
Dude, I'm telling you, when Tom and I start doing a show together, it's going to get juicy because we're going to disagree hard on stuff like this.
Everybody. Now, not too far behind is the guy who just dollar cost average, and way, way, way far behind is the person who was staying out of the market and just waiting for the market to recover to restart his dollar cost averaging. And even if you look at the length of these things, right? The length is important here. In 2000, it took the market 2 years to bottom. In 2007, 1.5 years to bottom. In 2020, we bottomed in 2 months. In 2022, the bear market, we bottomed in 10 months, right? Basically, what you're seeing here is that the time frame is about 10 months to 2 years of the market actually getting to a bottom, not that long. And from that point to the previous highs, 4 years in 2000, 3.5 years in 2007, 5 months in 2020, and 7 months in 2022. If you look at these numbers and you think about yourself as a long-term investor, you understand that if you have a 20-year horizon, if you have a 15-year horizon, hell, if you have a 10-year horizon, these numbers are well inside your range. There's no way to lose money if your horizon is 10 years plus and you're investing in the S&P 500. It's just statistically impossible. And if you
I'm going to end it right there. Tom, my friend, did you pay attention to what he just said?
you have a 10-year horizon, these numbers are well inside your range. There's no way to lose money if your horizon is 10 years plus and you're investing in the S&P 500. It's just statistically impossible. And if
That's the mentality. Now, granted, I like Tom, but that is the mentality of how people get wrecked. It is statistically impossible. All stocks are bad. All stocks are bad. I'm gonna put it to you this way. This is one of my catchphrases. Take it to the bank. All stocks are bad, but every once in a while, they act right. All stocks are bad, even the S&P 500, but every once in a while they act right. To say that you are guaranteed a return, a positive return over 10 years is Tom, come on, you know better than that. You know better than that. All right, let's rank this video. You guys rank it. I need to clean this up for the week. Hang on. You guys rank it. This is a brand new week, brand new set of videos we're going to go through. Where are you ranking Tom on here? Hey, while you type that in, don't forget you can save 64% on the Outlier annual pass. It's just 82 cents a day. If you're on the monthly trial, we'll even upgrade you. No sweat. Just shoot us an email and we'll take care of the rest. So while you type that in, let's have a chat. Like, what do you think? I had this quote I wanted to look at real quick. Over on my YouTube channel, I want you to vote. After you've posted your rankings there, go over to my YouTube channel. What do you think? Does going against the crowd make you a smarter investor or just a contrarian for no reason? Think different, win big, or the trend is your friend. I want to know what you think. Does going against the crowd make you a smarter investor or a contrarian for no reason? We'll look at those voting results in just a couple minutes here. So yeah, let's see what y'all rank Tom's video here. I didn't mind it until he started saying how doubling up. God, here's what you need to know. Here's what you need to know. Losers, average losers. This is Paul Tudor Jones. You can Google up Paul Tudor Jones, one of the greatest traders ever of all time. Mark Minervini wanted to be Paul Tudor Jones when he grew up. That's how much of the greatest trader he ever was. And even he had it on his wall. Losers, average losers, right? Winners, average winners. Buy the rip, don't buy the dip. Someone put that in the chat. Where was that at? Let me find it real here. I don't want to take credit for what you typed in the chat here. There it is. Nico. Buy the rip, not the dip. Exactly. Historically, he is right. But the problem is that we don't know the future. We can't see off to the right-hand side of the chart. We can't see what's going to happen next on the right-hand side of the chart. So because of that, we need to know our risk. And we know our risk can be limited by making sure we know where we're going to get in, where we're going to get out before we put on the trade, and how much we're willing to risk to find out if we're right or wrong. We got some 2s, some 5s. Manny, bro, go get that grandbaby. Go get that grandbaby. 6, like a 6-finger monkey on the hammer slide. Yep. 3, 6, 8. Not bad. 5, 2. A 5, 4, 5, 2. 3, same old. What email do I send it to? Oh, good question. Good question. It's just support@outlier.com. Yeah, just support@outlier.com. We'll take care of the rest. Good question though. Thanks for that. Amen. Tom would be like, yeah, just give me my 2. He would say that. 1s, 5s, exponential. Less than 5% of investors buy into new highs. And that is what makes you a contrarian. If you can buy into the new high, that's the contrarian part of it. This is different psychology. Half cup full or half cup empty? Good question. Sarah's here. Good to see you, Sarah. I've been watching him for 5 years. The 2 or 3? All right. I'm going to say, and this is my personal opinion, my opinion doesn't count any more than yours. In fact, I would say yours counts way more than mine because I love you guys. You guys are the best. I'm going to throw this into I'm going to give it a 3. And I'm going to give it a 3 because I liked a lot what he said until we got to his data point. And we all knew what his data point was going to say before he got there. But the doubling into dollar cost averaging is a incredibly irresponsible thing to do. I'm going to put this at 2.5 actually. It's very painful. And it's honestly incredibly irresponsible. If you are buying a stock that's going down and you're doubling up as it's going down, there are probably countless stories of people who have blown up, ruined their lives, ruined their portfolios, ruined their marriages, ruined everything in their family because it's not just about money. So, of course, be sure to tell me what you're trading in the chat and come back tomorrow where outliers like us will help you save time, make money, and start with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you click one of them. I also recommend you have a fantastic day and come to this afternoon's live stream. I'll see you there.